So welcome to the first DFK ANZ TAS webinar. I'm Lynn Greenaway, the Sales and Marketing Director for the Association Specialists, co-hosting today on behalf of our Managing Director, Nell Harrison, who unfortunately has lost her voice, which is not ideal in this situation. So before we get going, I would just like to acknowledge the traditional owners of the land, and I pay my respects to elders past and present. So for those of you online who don't know who TAS are, we are the largest association management company in Australia. We have offices in Sydney, Melbourne, Brisbane and Perth, which is where I'm based. And one of the great things about supporting over 75 for-purpose organisations is the breadth of knowledge and experience we get to share with our clients, which is really what today's all about. So on that note, I'm going to hand over to Angela Rasmus, the Managing Director, the Marketing Manager of DFK ANZ, who will facilitate the session. Thanks, Angela.
You're most welcome. I almost got a promotion there for a moment. I was going to take it. So welcome everybody, just extending the same welcome, and thank you for choosing to spend your time here with us today on this Lunch and Learn session. As you can see on the screen, we are talking about succession planning, all about planning for a profitable and painless exit from your business. So you've just met the lovely Lynn, who is our Sales and Marketing Director at TAS. And yes, I take care of marketing for the DFK ANZ group, but the most important people apart from yourselves on the call today are our two presenters. We have Stephen Bushell, who's the managing partner at DFK Gooding Partners over in Perth, and Gary Nugent, the managing partner at DFK Nugents in Melbourne, who will be sharing their insights and expertise with you today. Now, just a little bit of background, if you've not come across DFK before, we're a very large and diverse organisation, and the way that we speak about how we help is we have local knowledge on the ground where you are, national connections and global reach. And as you can see on the screen, many different ways in which we work with our clients and support them with their business growth. Now, we do need to let you know there is a disclaimer because the presentation that the guys have put together for you today is current as of now, but things change as we're very used to, especially in the last 18 months. So this is a summary. It's not a comprehensive statement or advice, but you will very much be welcome to talk to the guys, have a personal appointment with them about your succession planning after this event, and we'll give you some details about how that can happen. Now, succession planning is a process of identifying and developing new leaders who can replace the current leaders and owners when they want to leave, sell, or retire. It's an incredibly important part of being a business owner, thinking about what is going to be coming next in the future for you. So it's our goal today to really help you explore what the different options look like, to definitely learn how to navigate some of those pitfalls, and most importantly, to have a clear action plan that you can have and you can put together and move forward with after the information we share today. There are, of course, some technical complexities that are going to be specific depending on what industry you're in, but you'll get a good grounding here today to get you started in the right direction. So these are the topics that we'll be covering, and I want to reassure you, there is a lot here. You will have not only a recording of today's session, but also a copy of the slides that you can go back through. But we've got to look at what has been the impact of COVID on succession plans, because it has really thrown that hand grenade into the room for a lot of people's plans, not just with succession, but with business in general. So we'll be looking at what a plan is and why it is that you need one, and how it needs to be a living document, not something that you create and then just put away and don't look at it. We'll be walking through the decision tree, both internal and external succession options, very important steps, the vital steps that need to be in a plan to make it strong, those challenges that may happen and how to overcome, looking at navigating the tax and structure implications, understanding your business valuation guidelines and that action plan to move forward. Now, you will actually, on that topic of business valuation guidelines, there is a resource, one of two resources which will also email to you after this event, which shows you the different ways in which your business can be valued. Be really helpful for you to have a look at that. But we do like to do a couple of quick polls so we can have a better understanding of who we have on the line today. That helps the guys just be a bit more specific, perhaps, with some of the examples that they share. So they're very quick. I'm just going to bring the first up on the screen now. Okay, so, oh, and look, we've already had people answering it. Fantastic. So we're looking at the industries that you are in, And we've got quite a few there which are other. So if you wouldn't mind, you'll see the chat box at the bottom of your screen. If you could just pop in there what your industry is, that would be really helpful. But at the moment, we've got 25% of us that are here today in finance, professional services, education. Okay, we've got almost everyone has participated, so I'll just hold my breath for another quick moment in case anyone hasn't had the chance to vote. And then we will have a look at the results. Okay. And here's what we can see on the screen. So a big chunk of people in finance, and then we've got education and professional services next, and then that other, yes, if you can pop your other industry down in the chat box, that would be great. Okay, now we'll go into the second poll. So do you have a current succession plan? A yes, a no, or are you developing one at the moment is the question that we have here. So if you can take a moment to let us know, and that will help the information that we share. Okay, got half of us have participated. So just again, taking a moment for you to pop in your vote. We're almost there, another 10 seconds. Okay, I'll just share this one with you. Not surprisingly, we've got 90% of people that are here today don't have a plan right now or looking to develop one. So that tells us you're absolutely in the right place. For those of you who do have a plan at the moment, then you'll be looking at ways to polish that today, and we'll certainly be able to help there. And the final poll. Wanting to know, when you're looking at enacting your plan, do you have an idea about when the succession plan needs to be put into practice? Is it soon, next 1 to 2 years, 5 to 10 years, or is this way out in the future and you're just getting yourselves ready now? So great, the votes are popping in. Let's give that another few seconds. There's a good mix at the moment, so I'll share that in just a sec. Okay, and we've got all votes in. So a really good spread here. We've got people that are right on the cusp. We need to make this happen almost immediately. Then we've got a good mix of the 5 to 10 and the 10 plus years. So a good mix there. So again, no matter where you're at, you will get some insights today that will be very useful for you. So thank you so much for taking part in those polls. That's really useful. So now I will hand you over to, I believe Stephen is going to get us rolling, and I will keep an eye on the chat box. If there's any questions that come up, I will bring them up with the guys, and we'll time at the end as well. So thank you. Over to you, Stephen.
Thank you very much, Angela, and welcome everybody. Good morning, good afternoon, wherever you are in Australia. As Angela said, I'm over in Perth, so not quite a lunch and learn yet, but maybe a morning tea. So today we're going to cover quite a lot of information, and so we are going to be at a fairly quick pace. Myself and Gary are pretty good at going off track a little bit, so our challenge is to stay on track for the amount of content that we've got to get through. So it will be a little bit rushed, and we do apologise for that, but there is a little bit of method to our madness, and we've added a couple of extra slides just to address COVID, which we think is an important one to cover off. But before we do, we'll kick off with some stats. So the DFK Wavelength Survey is a survey that the DFK ANZ have been running for a number of years now. And one of the questions that we've asked is around succession planning. And over the last couple of years, more than 50% of our responders don't have a succession plan, or are in the process of doing one. So that survey poll that came through just a minute ago with 90% don't have or are still doing one doesn't surprise me. And it's amazing how many clients that we talk to, a bit like their will, they think that the moment they do a succession plan, something bad's going to happen, so they choose not to do it. Or the other questions and comments we get back is, oh, where do I start? Give me a box to fill out, give me a form to fill out. And unfortunately, there is no form to fill out. It comes with a lot of experience. And one of the things we always say is there is no legislation that controls succession planning. It's not like the Tax Act where you read your way through a problem and come out with an answer. It's all based on experience and bringing together a number of factors, including some legislation such as tax planning, etc. So the biggest reason for failure of succession plan is a lack of communication. So a lot of people that we've come across have got, yep, I've got a succession plan, It's sitting on the shelf alongside my estate plan, and it's my will's in the safe. And have you communicated that to the people who you think are the succession, are your successors? Oh no, we won't tell them that. So if you're not telling the people who you think you've got lined up for the succession plan, how is this plan ever going to work? And it's not surprising that it would fail. So I think the number one tip there is involve the people who you think are your successors, whether they be family members, management, or third-party sales. Obviously a bit harder because we don't know who the potential purchasers are, but certainly MBOs, management buyouts, and passing businesses down to the next generation. Communication is a must. A couple of other stats just to get us in the mood. The most recent survey I could find updated is Perpetuals ran a survey last year on wealth transfer in Australia, and 53% have not discussed their will or legacy with their children in Australia. So that's obviously a problem around that communication piece. Intergenerational wealth estimate, there's lots of numbers that fly around if you Google it, but the most accurate that we can find is somewhere in the next 10 to 15 years, there'll be an estimated $3.5 trillion transferred from one generation to the next as the baby boomers continue to retire and move on. Pretty big number. If 50% of people don't have a plan, that's quite a lot of money that's going to be transferred with no plan. And that's why we're here today, to perhaps help that. And the baby boomers, as I said, make up approximately 24% of the population and control 51% of the wealth, which feeds into that point above. So let's address on the next slide, let's address COVID and the elephant in the room, as in most places. And to be honest, COVID's here for a while, is my opinion. So it's not something that we can ignore. And one thing I've said to many people is there is no COVID manual that we can pull off the shelf and navigate our way through the last 18 months and beyond. We're all making it up as we go along, as are some of our illustrious leaders. But in terms of COVID and what that impact has on our SME market, some of the things that we're seeing is the working from home has given employees particularly, and many stakeholders, a lot more flexibility. A flexibility to work from home, flexibility to do their job from home. And as an employer, that's made it a little bit tougher in that it's very hard to control our workforce when they're working from home. Having a chat to Gary earlier on this week, one thing we were saying is, well, how does that impact on their decisions? How does that impact on their ability to look at the business and perhaps put themselves in the business owner's position and saying, yep, I actually want to be a Gary. I want to buy into this accounting firm, or I want to buy into this financial planning business when they're working from home. And obviously the East Coast, many states have been in lockdown for quite some time. What does the culture of the firm look like? What does the culture of your business look like? That's all going to have an impact on the succession plan. It also has given employees a lot more choice around, am I now just simply chained to the office? No, I'm not. I can actually work from home. I can work online. I can work remotely. I can actually take a job in London and work from Sydney. And I've seen that in a number of cases. People are now taking international positions and working from their home. Which certainly wasn't the case a couple of years ago. And I think as the world's getting used to working remotely, it's opening up more and more opportunities for people. What does that mean for employers, and what does that mean for the stakeholders who perhaps you've got your eye on one of those key management people to take over your business one day? Well, you've got to have a completely different conversation with them. You've now got to provide opportunities for them to be able to work from home and to perhaps become a stakeholder in your business. So no longer can we just assume that potential stakeholders are going to remain loyal to you and your business and they've been working for you for 10 or 15 years. I think the bottom line of all of this is your employees and your management staff, etc., your key personnel that are perhaps going to participate in a management buyout are going to have a lot more choice about where they hang their hat and put their toothbrush. Maybe they're not going to no longer feel like they are tied to your firm. They're going to start looking for other options. So for those who haven't had a plan, who don't have a plan or haven't had that communication with their staff, particularly senior management, you have to, because these guys are going to be sitting at home with a lot more choice and a lot more flexibility. And I know for a fact many of our staff are being headhunted by other accounting firms, in our case, where they're offering working from home as almost a first point of call. So it's something that we really need to think about. COVID's here to stay, and we really need to be addressing that as part of our succession plan. In terms of the next slide, the other thing I just wanted to mention before I throw over to Gary for the next one is the impact on timeframes. In my mind, as a managing partner of an accounting firm, if I say the good old days, it's probably 12 or 18 months ago, my planning looked like something like the top, where I would always have a 12-month succession plan, I'd have a 2-year succession plan, I'd have a 5-year succession plan. The 12-month succession plan is more around, have I got the right people on the bus, and am I positioning my firm? The 5-year plan has always been a bit more of a stretch target for us, but we always have our idea on who are the up and coming managers, who are the up and coming partners, who's going to be retiring in the next 5 years, what does that look like? And so we've always had a 12, a 2 and a 5-year plan in our succession planning. What does COVID look like? Well, in terms of the key management now, my plan is now 3 months, 6 months, 12 months. Sometimes in the last 18 months, we haven't known what we're doing in 3 months' time, let alone 5 years' time. And I think it's fair to say even now, we still really don't know where the world's going to be in 5 years. So I think in terms of strategic planning, I guess my message there is that short-term, long-term has changed significantly over the last 18 months. And that's really changed our mindset as to the speed in which we put plans together, the life, the longevity of those plans, and how often we have to be reviewing them. So this slide I've used many, many times in discussions that I've had with clients, and I just thought I would put that one in there at the beginning of this process, just again to get your mind thinking around 5 years is a long time now, and I think it's going to be that way for a number of years to come. So I'll leave that thought with you as I pass over to Gary, who will talk through the next stage of this presentation.
Thanks, Stephen. Look, the situation with succession planning generally, as we've just heard from in terms of stats, is that we've got a very low benchmark for success. So those of us that are sitting around with a view that, look, perhaps my planning isn't as solid as what it needs to be, you're in very, very good company. And I think the point about change and the environments we're living in is that whatever you had planned, 3 and 6 years ago or 3 and 6 months ago has probably changed again. So the fact of the matter is that this is an ongoing process. Some would suggest, therefore, well, what's the point of having a plan? I mean, why don't we just wing it? And the fact is that there are so many components to a succession plan and making it a success that, the whole story of, failure is driven by an inability to implement a good plan. In terms of your business, there's 2 elements to it, as we all know. One is the income. In other words, what I get out of being a business owner, with the income as I generate along the way. But the second and most important aspect in terms of succession is, of course, the capital value I have to leave and sell, which often will fund my retirement strategy. So one of the things that we are seeing is a fairly big appetite for risk. There's a situation where there are lots of businesses that are chasing higher returns. And as a consequence, what we're also seeing is that the ability to put your business on the market and sell it at a reasonable value is probably never been better. But the other side of that is that if your business is poorly planned and poorly structured and not prepared, then generally you have your bones are picked over by the vultures and the hard-edged due diligence professionals that we are often called on to be, where we pick the weaknesses in the business. So as this slide is suggesting, you need to keep this process dynamic. You need to be looking at internally what are the aspects of my business that if I was buying it today, would I change? So it could be that your management structures are poorly arranged. It could be that the way you've got the actual entity structure doesn't suit your process of exit, because it might be that the business is either heavy with passive investments like cash or property, which may not necessarily need to move with the business. So the restructuring of it is important. Knowing how much you're relying on to fund your retirement is a really, really important thing, because often this is the key asset that people retire with. So knowing that in advance is pivotal, because the expectation when we do evaluation for businesses often is it comes in a fair bit lower than what somebody might need to have a comfortable retirement. Now, if your timeframes are 1 to 2 years, then you haven't got a lot of time to change much about the business. Luckily, if your timeframe sort of 5 to 10 years, then there's plenty of levers you can pull to improve value. And if you don't improve the value and you're simply selling something that's tired and lacks the luster that the business next door offers, then by comparison, you're certainly going to be passed over and values will diminish. In terms of the next slide, what's important in terms of a succession planning is that it's a living document. And as we've talked about in terms of change, it's really, really critical that the conversation about what may and may not be part of the business is part of your planning. Stephen mentioned this issue of flexibility with staff. So the point would be that, if your succession plan is based on a key employee that's resident in your building today, and you've always thought, well, he'll be the one that'll buy the business eventually, but suddenly he gets offered a job across the, whether it's from Perth to Sydney or Sydney to Perth, or as Stephen mentioned, even to London, the opportunities for these guys are now enormous. So you've got to be able to understand what all of those changes are and how it impacts on your business and the value, and what your plannings are in terms of, well, what's my plan B, plan C, if things were to change? And all of those things, they have a metric about them, which obviously will lead to as this conversation continues. Naturally enough, our success with succession planning comes down to good advice. There's obviously a number from the finance community in here today, but it's really, really important that the advisors are up to date and they don't treat this process with their clients as something where it's a set and forget, because it's certainly not. Stephen, maybe if you then want to run through the next aspect.
Just like everybody else, I forgot to turn the mute off. Thank you very much, Gary. So where do we start with this? Let's put COVID aside for a sec. Hopefully we haven't spooked too many people about COVID. There is still an opportunity to sell your business. There's still an opportunity to pass it down to the next generation. So the decision tree is all about, and noting that 50% of the people on the call today don't have a plan. Where do I start? What do I do? Give me a form to fill out. As I said, succession plans are very much an art, not a science. So there is no legislation around it, as I said earlier. So what do we do? Let's explore our options. So our options are, there's really two options if we distill it down. The first option is to sell internally, and I'll come back to what that means in a sec. And the second option is to sell externally. So whether we're internally, if we focus on that for a minute, we've got two choices. Depending on what our business looks like, it may be a family business, second, third, fourth generation, first generation, it doesn't really matter. If it's a generational business, then our first option is to sell or transition that business to the family members. The second one is to look at our management, who's already running our business, and perhaps there's an opportunity to do a management buyout, an MBO. The third option is, if neither of those options are appealing or possible, then the other option is to sell our business. And if we're selling our business, what does that look like? What do we need to do now? So if I just explore that first option, the internal piece to start with. So if we're passing this down to the next generation, or even to sell to management, we always refer to having the bus. So if our business is the bus, we've got to look at what seats are on the bus and have we got the right people in the right seats. And it's a really important analogy, and I think it just holds true all the way through the discussions that we have with many people about succession planning, is have we got the right people on the bus? The first of all, having the right seats on the bus means we need to look at our organisational chart. To unlock the true value of goodwill in your business, you've got to picture your business without you if you're the key stakeholder. People are going to pay more value if they can pass that business down away from you or take that business away from you and it still be profitable. They come along and add their value to it and grow the profit. That's really going to be what's going to unlock that goodwill IP component of your business that's either in your head or certainly part of your experience and what you do as a job. So as a business owner, stepping away from the business and letting go is a big thing for people. And particularly we come across where there's a family business and mum and dad have been running this business for the last 30 or 40 years. They've built it from nothing. Children have either worked in the business or have got some interest in the business. And we're ready to step aside, step down, retire. Have we got the right people on the bus to take over what we do every day? What comes naturally, what we take for granted? We absorb a lot of the pressure because we've built this business from scratch. to put somebody into that, quite often we end up in a position where we're like, you know, it's actually going to take 2 people to replace you because you've got so much inherent experience here. To impart that onto one person is just going to be too overwhelming. So we've got to look at perhaps splitting your role out and looking at what that looks like, and then recruiting the right people. We can't just start at the age of 65 to start planning our succession and selling it 6 months later. We've got to groom these people up, whether they're the first generation, second generation coming through, or management. So current performance, potential performance, readiness and timing are really important when we're looking at those seats on the bus. Family members, really interesting. We've had many cases where we said to mum and dad, so who's going to take over this business? Well, son number 1, son number 2 and daughter number 3 are going to take it over. We go and talk to those and they're like, oh, no, we've got no interest in taking over this business. We didn't know that dad thought about that. He's never communicated that to us. We're happy working in here, but we don't want to take the risk. We actually want him to sell the business and leave all the money to us in his will when he's passed. So it's a very different discussion between mum and dad and then the next generation. So again, it's having that conversation with the next generation, making sure that they're aligned. The existing structure, right? So family trust, for example, where we see a lot of businesses started up in a family trust. You can't sell a family trust. It doesn't work that way. So having that right tax structure is really important, which we'll cover in a minute. And how are the current owners going to be compensated? If we're passing it down to family members, are they going to borrow money from the bank? Are they going to come to dad bank and borrow money from dad as a vendor finance type arrangement? Or are we expecting mum and dad, or is mum and dad expecting them to go and put their mortgages, or put their houses at risk, young families, bills to pay, and borrow a lot of money and give it to mum and dad? And again, we've got to have those tough conversations with both sides. If we're looking to the next slide, just to look at management buyout for a moment. So sorry, to family handover, I've covered this already, most of it. How much does mum and dad want for the business? How much does mum and dad need from the business? Which children are suitable? If there are children that are not interested in the family business, how are they going to be compensated? Perhaps there needs to be an adjustment in the estate planning side of the plan. And is that estate plan fair? And is it structure ready for handover, which I've already mentioned, particularly around family trusts. If we cover off on the next slide, Angela, is the management buyout. So if we're looking for senior management, as we've alluded to already in this presentation, and Gary made mention, is perhaps you've got your key management working from home, and perhaps their mindset is changing around coming into the office every day or coming into the factory every day and taking over. Perhaps they're now looking at other opportunities. And again, we've got to have those conversations with them and making sure we're keeping that culture of our business intact during these COVID periods. Considering bank finance versus vendor finance, whether there's cash, whether we're going to retain some ownership or part of the share structure if that's possible. Vendor finance doesn't suit everybody, particularly if we're relying upon selling this business or passing this business down to management for part of our retirement plan. So that's where we need financial planners' involvement to make sure that we can afford to retire, and we also can offer some vendor finance to help the next generation, the younger people, get going. Bank debt may or may not be possible depending on what we're selling and what the business looks like and what assets are sitting on the balance sheet. Are there any skill gaps needed in management? So we assume that management's doing a great job in their particular field or their particular area of expertise, but what gaps do we feel as the business owners at the moment that we just simply do on a day-to-day basis and not really think about it? We've now got to picture ourselves no longer being in the business. Are there skill gaps that need to be filled? And again, this is why we don't want to talk about a succession plan 6 months before enacting it. We need to be talking about this way before then to make sure that those skill gaps can be filled. And what impact is the new owner on the clients and customers and market going to be having? Are these senior management in touch with our current customers? Do they have the ability to grow this segment? Do they have the ability to manage this business going forward? Are there unique skills that we have that we need to be able to impart on them? And as we talked about, similar to the family side, the structure, which we'll cover off in some more detail soon. If we flick to the external, so external selling to another party is a very different model, in that there are maybe many gaps to be filled, but equally now we're turning our attention to what the structure looks like, who we need to be putting on this bus, what sort of shape do we need to be handing our business over, and what's going to attract the best price for our business. Obviously, we're trying to sell it at the best price to fund our retirement, to fund our next stage of our lives. And we need to make sure that when we hand over this business, that the due diligence that the purchaser or potential purchasers is doing with their accountants and their lawyers and their team of advisors are actually working their way through is this business sale ready? And quite often what we do is a bit of a mock due diligence on the client to say, if we were an accounting firm coming in and looking at your business, what does that business look like? Have we got the right systems in place on the screen there? Can this business be run without you? Do you have strong financial reporting, particularly around the regular reporting and surviving the EBITDA multiple number, which we're going to cover in a moment? Will it withstand due diligence? Is the current structure suitable? Have you considered all the capital gains and other tax implications? And is the timing of the sale important to the marketplace? So with that, I think, sorry, I've just lost myself. What's the next slide, Angela? Am I throwing back to Gary here?
Okay, thanks, Stephen.
Sorry, Gary, I got my slides around the wrong way. Apologies.
No, that's all right. It's a confusing issue. There's no question. All right. So look, the issue with developing a strong plan, it is really important to have a step-through process. And if we go through the 5 steps, everyone loves having numbered steps. It sort of gives us a sense of order and a sense of I've got things under control. The fact of the matter is that within all of these issues, and Stephen, in the issues that he's covered, you can imagine that every single one of those could lead to ongoing discussions and further definition as to what may or may not need to be done. The first thing, obviously, establishing the timeline is critical, because it changes. If we think about our business like a house, if do I renovate it before I sell it, or do I sell it as a renovator's delight and leave all the value for the purchaser? Or do I sort of do something in between? It really comes down to the timeline and the expectations of value that you're looking to extract. The more time you have, obviously, the more that you can do to improve the value, and be in a situation where, when you're dealing with people like Stephen and I coming in, acting for purchasers, where we look at a due diligence that basically picks everything apart, well, the question is just the reverse, is you get a Stephen or myself in, and what we look at is, what would a purchaser be looking for here? And how do we make sure that all the improvements that are required are being addressed? Some of them just simply won't be able to be addressed, but obviously those that you can, the low-hanging fruit, the systems, the management process, all of those sorts of things that you can, and you've always been meaning to do, then you just put them in play. The value of the business, really important that you establish that early. So one of the things about a valuation process is that there's a methodology that's used, and we'll go through in relatively quick detail, but we'll also give you a handout on some of these steps. But do that early, like, in other words, in fact, at the start of the process, because what you might find is that when you actually go through those metrics, you'll be somewhat surprised, either hopefully positively, but more likely than not negatively. And you'll sort of see that actually the business isn't worth what I thought it was. So straight away, it gives you the impetus to then, deal with those 1%ers, those things that you need to do. And then the justification is not just the additional income you'll earn over the journey until you sell, but increased value of the end transaction. Stephen's mentioned some of the tax implications of the transactions. I mean, they're as broad and as complex as the structures you have involved. One of the things about tax, and in terms of business advice, really the way it boils down to is the more tax you pay, the better the outcome, in as much as it's obviously a positive reflection of the value that you're receiving. But that said, small business concessions, there's just an enormous number of capital gains tax concessions that you can take advantage of. But if you're not properly structured, or if you haven't planned in advance, they can also turn around and smack you in the face, because you go, well, hang on, if I just did these things properly, or if I just timed the transaction, if I sold the shares rather than the business, or if I, however you want to do it, or you are able to do it, you can improve your value outcomes substantially by just minimising the tax involved. Documenting the milestones is relatively straightforward. It's just a situation of being clear about what those action plans are. And external assistance is not just business advice. It can be, sales assistance. It can be, Angela putting a marketing plan for the business together. It could be a situation where I look at all of the marketing collateral around the business and realise that it's 30 years old and maybe it's time for a refresh. So external assistance is across all of the aspects of the business. To the next point, or the next slide, really what it comes down to is, in terms of major challenges, is if there weren't challenges in business, then you're actually an employee. So for mine, if you take on the fact that, you own a business and you want to extract value, then that equates to challenge, because with risk comes reward. Those that seek to avoid all risk and all challenge, at the end of the day, become employees. And ultimately, as we all know, leaving an employer, you don't walk away with any capital value. So the next slide talks about a sanity check. And I think it's constantly, you'll see that there's a theme going through this process, is that what we're looking at is looking at the issues, testing what the issues are, improving those things, and then going backwards and then reassessing those issues after the event to say, well, are these sort of key things addressed? One of the things that we see a lot of is that, the vendor of the business is very, very keen to sell, but then when it really comes down to it, mum and dad don't want to leave. They've got nothing else to do, or they haven't had the conversation with their children, or they find that their, kids not only don't want to take on the business, they're not capable of taking on the business. They're just not willing to work as hard as what their parents did or have done to build the value. The future proofing is almost impossible to manage, but if you haven't looked at it, then how are you actually dealing with disruption? If we look at all the household names of Facebook and Google and Atlassian and Canva, these are all names that have appeared in the last couple of years, you know what I mean? So the fact is that, and all of those are owned by billionaires. So the value is not necessarily about Twiggy Forrest digging up, resources, because that old scale business now is being sort of replaced with far more adept and fast-paced disruptive businesses. And a question of obviously managing how you deal with those. So Stephen, I might just throw to you now to talk about some of the structure issues.
Thank you, Gary. So also conscious of time, we want to leave some time for questions at the end, but I will touch upon probably the legislative piece of succession planning. I mentioned earlier there is no legislation or rule book around succession planning, but one of the things that we do need to keep a very close eye on is that tax. And so not all business structures, as I mentioned earlier around family trust, are well suited to implementing a succession plan. So we just thought we'd touch upon for 30 seconds each on these as to what each of these structures mean and how they can impact on succession planning. So a sole trader, somebody comes to us on a regular basis and says, I've built up the business from scratch. I've started it in my home and I've now got a small office, but I'm still a sole trader. I've got a couple of employees. They're not really that interested in buying my business. One of the things that comes to mind straight away is personal goodwill. How do I extract the most value out of my business when I am the business? And one of the things we've talked about to a number of consultants is starting to build a brand outside of just yourself. And that may be just simply starting off with a different change of name, or perhaps you're trading as something else that has value. But what we're trying to do is over the course of a period of time, and again, planning around the succession and timings of that, is making sure you leave a run rate long enough to build and extract the goodwill and IP away from yourself. So the more distance we can put, perhaps we bring in some other consultants, we bring the seniors that are working for you to the front, so that people are now actually realizing that it's more than just Gary. It's more than just Gary and his team. There's actually a whole business model that sits behind that. And the more that you can work your way out of that business over time, the more chance you've got of unlocking that goodwill. Partnerships is an interesting one in that basically we need all partners to agree to sell. And depending on the complexity of a partnership, as you can imagine, a large professional law firm or an accounting firm that runs under a partnership, trying to get all those ducks in a row and agree on sale and the price, the timing, what it looks like, who we're going to sell to, Partnerships come with their own complexities. And that's basically sometimes like herding cats, as they say, is we're trying to get all the partners in the room to agree on when to sell and to value. Sometimes one partner will say, well, I'll buy you all out at that price. Great. Well, that might be a conversation that we start as an internal buyout. So partnerships, again, need their own different discussions to the others. Family trust, discretionary trust, as a generic statement, are very difficult to sell, but just purely by the legal structure of how they are. Family trust is set up, as they suggest, for a family structure to hold key investments. Generally, typically, we don't put an operating entity into a family trust. The general structure would be family trust owns shares in a company or units in a unit trust, and that's where the operating entity would sit. And for the main reason that family trusts, as I said, are difficult to sell, because almost impossible to sell because of the pure legal nature of a family trust. That leads on to unit trusts. For those who are not familiar with unit trusts, think of them similar to companies. Units are issued just like companies, they're registered. The flexibility around tax and distributing of profits is probably where the difference between companies and unit trusts are. Unit trusts don't pay tax, but distribute all their profits to their unit holders, who then pay tax. Companies obviously pay tax at 25 cents or 30 cents, depending on the nature of the company business and tax rates at the time. So unit trusts do attract capital gains tax. If you were to sell your unit trust units, they are tradable. People do buy unit trusts, or what quite common happens is the business is sold out of a unit trust, which therefore the unit trust has the capital gains tax event, which then can be distributed down to the unit holders, and capital gains tax concessions can apply depending on what's happening in the structure. Similarly with companies, again, the company has the power to sell the business within the company. The only subtle difference between that and unit trust is that there are capital gains tax differences, and the capital gains tax discount wouldn't apply if there was a company involved in selling the business. In that case, the vendors may be pushing for the sale of company shares, which we'll touch upon, which we would consider when we were looking at the opportunities to sell the company versus the business within the company. And the other one that I just wanted to add there is a couple of points. Is one, there's a bunch of small business concessions around capital gains tax, depending on the size of your business, whether you meet those small business concessions, and some of those are very generous, particularly upon retirement. I certainly encourage you to talk to your advisors about that. And stamp duty, transfer duty is different in each state, so we don't go into any of that in too much detail, but again, that's something that we need to consider. So just rounding off the tax, what can I do now to help me better? Have conversations, get the right advice. Most of the answers when you're asking what's the tax implications of this, the first answer from your advisor is going to be depends, because until we have all the facts around your unique characteristics of your business and when it was started and how old it is and who's involved and what the structure looks like, it's very difficult to give a generic answer. You need to cover off on all the tax outcomes to make sure there's no surprises. We don't want to get to the end, particularly as advisors, to say, sorry, we forgot about that because we didn't realise, and there's a tax bill that's at the back end of it, particularly when you're planning your next stage of life, whether that be retirement or moving into a different business. You don't want big, nasty tax bills to come through at the end of it all. Also consider what you're transferring in terms of assets. As again, I touched upon with stamp duty, particularly if you're transferring land, you may be selling the business out of an entity that has land in it. We don't want to sell the land. We want to retain that as the landlord. Then we need to make sure we either extract that land out of that structure or we extract the business out of the structure. But again, understanding what assets you've got in those vehicles and what's going to who is really important, something to consider. Timings are everything. So selling one side of June versus the other side of June, for example, has different tax implications around timings. And if we can push the tax payments out a bit further using all the legislation that is at our fingertips, then of course we're going to look at all those options. And then also it needs to dovetail in with your estate planning, depending on where you are in terms of your life and what you're planning next stages of your retirement, perhaps. So with that in mind, I'll throw back over to Gary to talk about the valuation guidelines.
Okay, so not surprisingly, the whole idea of valuations and, excuse me, Angela, if we could just move to the next slide, is the fact that we approach this when we do a valuation, especially if it's for a bank or for a situation where there might be litigation involved, or where you're in a situation where I want to know specifically what something's worth, it's not dissimilar to valuing what a property might be. You look at what alternative sales would be, and you come up with a process of a calculation that effectively makes sense. But in the end, the value is what a willing purchaser and a willing vendor are able to transact at. The idea of capitalisation of future maintainable earnings, what it does is it creates a situation where you've got to review your reports and look specifically at those things that were within the business that, you know, as noted there, is consider the normalisations. There's things that, you know, maybe you're paying salaries at too low a level or too high a level, or you've got too many vehicles in there, or you've paid for a holiday in there that perhaps isn't really business travel. All of those things need to be taken out, and then you've got to look at the business from the point of view of what's a purchaser when they're buying an income stream. How do they see this as being a value? The idea of then the following items, discounted cash flow, net tangible assets, is probably more where there's a more substantive passive level of asset within the business, as Stephen mentioned, property and the like that you might want to keep in or sell out. Rule of thumb's always been that classic, you know, look, businesses in my industry always sell for 2 times or 3 times or 10 times. The question is often who's the purchaser, where the market is. I mean, if we were to look at, you know, valuation multiples of the likes of, you know, a business that's not making any money and they're still selling, I'm trying to think of the name of it, but, you know, $39 billion, you know, you sort of sit back and go, well, some of these rules of thumb and industry norms do get thrown out the window. That doesn't make them irrelevant, doesn't make them that you can't assess them, but it does mean you've got to take them, you know, into account when you're looking at it. So we are going to give you a slide on what these things are, which will show you the various elements of the of those valuation guidelines and the things that you need to take into account. We're also going to give you a handout on what we would normally do with our clients in this aspect. We often have what they call a board of advice, and we're giving each of you that from the point of view of, for the advisors in the room, can look to, well, what are the services that I could be providing to my clients? And for the business owners in the room, what are the expectations of services I should be expecting from my advisors? So we're including that in the handout that Lynn will send you afterwards. The valuation guidelines, taking into account, you've got to stress test all of the issues. So, you know, most of these points that we're raising here are just common sense. They're things where you've got to look at it from the point of view of a purchaser, and what do I need to strip out of the business, and what do I need to polish and make more valuable in order to get a better outcome. The discounts on valuations probably important from the point of view of understanding that, you know, if you're in a situation where a sale is imminent and there's a degree of distress, then you can probably expect that a purchaser is going to probably push you fairly hard on what the sale outcome might be. Understanding the impact of the discount is really important, because you might be able to mitigate that risk. So basically, I think the issue with this now is to look at, from your own point of view, all of the things that are particularly pertinent to yourself individually. Have a look at the things that we're going to hand out. And with that, I think I will hand across to Stephen to basically bring this thing home.
Thank you, Gareth. I think we've got about a minute to go before we've got some question and answer time. So where to from here, everybody? We've obviously touched upon a number of topics today. What we, as I said earlier, we've said throughout this presentation, is there is no manual or no template to work through a succession plan. It's a coming together of many, many aspects. But what we have tried to do in these 10 or 11 points is outline a bit of a plan that we would not typically work through. So in initial meetings, we would identify the outcomes, particularly for the current stakeholders. Exactly what do they want to achieve, and what are their timings around this? Have we got a 50-year-old that's got a 10-year plan? Have we got a 63-year-old that's got a 2-year plan? And everything in between. So that's something we really need to do. The impact of COVID, as we said now, this COVID is going to be around for some time in some form for quite some time. We need to address what it means now and what it means in the future. And I think that's probably the fundamental message we're getting out through this webinar that we haven't in the past. Obviously, we need to address that. Review your current resources. We talked earlier about seats on bus and people on the right seats. We can't emphasize that enough to make sure exactly understanding your structure, what it looks like without you, who's going to be driving that bus when you're not around, and is this a saleable bus? Do we have the right people in the right positions? Look at your structure, making sure that you've got the right tax advice around that to make sure that we understand our capital gains tax exposure, we understand the timings of the tax. It's all great to sell your business for a record price in your industry, but then you need to allow for tax. And tax may be due in 12, 18 months, 20 months time, but at least we need to set aside the funds for that and make sure that that's built into your retirement plan. Share that succession plan. As we said right at the beginning, it's amazing how many times people don't share their succession plan because they think something's going to happen, or it's just haven't got around to it, or I'm too busy, or they should know already what my plan is. I've talked about it enough to them over the years. Well, that's not quite the case. We actually need to sit down and have a formal chat to that next group of next generation, or that group of management, if that's what we're looking at. Formulate some milestones. This one's a difficult one. It's always hard to plan. As we said earlier, we can't plan what we're doing in 3 months' time at the moment, but let's get some milestones in place and let's put some timings around that, even if it's just to refresh the plan and see how we're tracking. Monitor it, making sure you check back over those milestones. As Gary said, this is a living document. It's not something we put on the shelf with our will and forget about. It's something that needs to be a work in progress over several years sometime. Allow for some bumps in the road, allow for some delays, allow for external factors such as COVID. I'm sure all the succession plans from 2 years ago have been thrown out the window in terms of timings, and we need to allow for those, even though they are difficult to foresee. Or finally, do you have a backup plan? When all of that fails, what's next? I think that's one of the questions that we do ask our clients from time to time. So with that in mind, I hope you've enjoyed our session and you've got something out of it. Even if there's just 1 or 2 takeaways, that's great. And I'd like to throw back to Angela to close out this session.
Thank you, guys. Yes, as Stephen and Gary have pointed out during this presentation, there is a lot of moving parts to a succession plan. Now, when we took those polls at the beginning, some of you were right on the cusp, others have got this further into the future, COVID to one side, but it is often really helpful to have a conversation with someone that's been doing these sorts of approaches for some time. So you'll see on the screen at the moment, if you email Lynn directly, lynn@theassociationspecialist.com.au, she'll be able to put you in touch with the guys to actually set up that conversation for that first step, perhaps to streamlining the succession plan you have, or perhaps getting started with those ideas that are in your head as to what direction you're wanting to go, and actually putting some formality around that so that you feel more in control about what the next steps are. I'm just checking the chat box to see if there are any questions. You're most welcome to pop them into there. But what you'll often find as well is when I send out the recording to you, the copy of the slides, and also the resources that are referred to, you may come up with a question that you're wanting to ask, and that's what those sessions are there for you. 2 other things to share with you before you disappear. There's other areas, obviously, where DFK ANZ can help, which you can see on the screen at the moment. And we also have the collaboration with TAS at the moment. There are more webinars coming up, one in September. On the 28th of September, we're doing an expertise webinar on cash flow. Cash flow is king and queen at the moment. And also on the 9th of November, there will be one on strategic planning for innovation. So please keep an eye on your inbox, and if you'd love to come along and join us for those as well. The whole idea is for us to be able to give some tidbits of information that open up a new possibility for the way in which you are doing business. So thank you so much for your time on behalf of both DFK and also the Association Specialists. And we look forward to being in touch with you and being of service in the future. Until then, take very good care.